Sean's going to talk about the Grinch who stole stimulus and what all that means. But I'm going to turn it over to you, Sean, to talk about the Grinch.
Okay. So good morning, everyone. And as you can see, given the holiday season, I figured I'd steal a little topic headline, the Grinch that stole the stimulus. And this is just referencing the Treasury action late last week with regard to terminating some of the Fed facilities that were in place via the CARES Act. So let me just start with, sort of what transpired. And what you have up here is just the balance sheet of the Fed. And there were three things that Treasury Secretary Mnuchin said that I think, that are important. The first, if you look at the page here, the facilities are highlighted, and the four at the top. What the Treasury Secretary first did was he asked the Fed to approve the extension of four facilities. Two of those facilities use the Exchange Stabilization Fund. That's the commercial paper and the money market facilities. And there were two that didn't require Fed funding, being the primary dealer facility, as well as the payment protection facility. And he asked them to extend that. They expired at year end, to extend it for another 90 days. And then the next actions were the ones that kind of caught the attention of the folks, and that was for the facilities that used CARES Act funding. That's the corporate credit facility, the municipal loan facility, the Main Street lending facility, and the term loan facility, the TAL facility. His comment was that, Congress's intent was for the authority to originate new loans and to purchase new assets was to expire on December 31st. And the Treasury was not providing the approval to extend those facilities. And importantly, in addition to that, he's requesting that the Fed return the unused funds to the Treasury, in essence, allowing Congress to reappropriate, the $455 billion in funds. Simple to say, the Fed was none too happy. You may have caught some of Chair Powell's response. It was really much along the lines of, listen, we, the Fed, would like to have all the tools at our disposal to deal with supporting the economy, with the thought that, it's still not on sure footing. We're not out of the woods yet, and having more tools at their disposal would be helpful. He also said, there will be a day when the economy is on sure footing, and, that's the day you return the tools to the shed, if you will. It's just not now, from the Fed's perspective. So with that said, does the Fed have any wiggle room from a legal sense to combat this? And, let's first start with, from a standpoint of extending the facilities, absolutely not. Within the act, the Treasury has to provide the approval for them to extend the program. So no wiggle room there. And then when you think about it from a mechanics standpoint, the Treasury actually makes the loans to the Fed facilities, and it's not directly to the borrower. So the loans are made by the Fed facilities once the Treasury funds it. And when you look at the CARES Act, it does state that the Treasury isn't to make new loans, or, it expires on December 31st. But this is where the legal interpretation of it comes in. The Treasury's already made those loans to the Fed facilities. So technically, could the facility, which already has the existing loans from the Treasury, continue to make new loans and it not be considered a new loan from the Treasury perspective? And that's the question, and that's why the returns of funds is so critical. Because if the law allows the Fed facility to keep lending into next year, but it doesn't allow the Treasury to provide more money, by requesting that 455 billion back, Mnuchin is sort of, handcuffing or preventing the Treasury from easily reversing that decision, right? So think about it. If the money stays, one, that the Fed facility potentially could continue to make loans, but also if the money stays, the next Treasury Secretary can probably restart the program fairly easily. If the money goes back and leaves the facility, now it's going to take an act of Congress to sort of restart those programs again. And that provides certainly creates a little uncertainty when you think about the Senate. What goes on in Georgia if we maintain a Republican Senate. Now again, you sort of have that bipartisan situation as far as getting that those acts, those facilities restarted. If you get a Democratic Senate, then it's probably not an issue. But point being, having that insurance policy would have been nice. And then it comes down to, does it really matter when you look at the utilization of these programs, right? They've hardly been tapped at all. And so that begs the question, with utilization so low, does this even really matter? I think you heard Mnuchin say, we don't need to buy any more corporate bonds. I mean, the markets are, behaving fine. These programs, while they were put in place, they haven't been used. It's not a big deal to move on. I mean, that's one way to look at it. But another way to look at it is, you could argue that the importance of those facilities isn't really the utilization, it's the fact that the backstop is provided. That's what the Fed put is. And if you look, you can see when the Fed initiated the facilities, this is the corporate bond spreads. You saw the corporate bond market heal quite quickly, and that went across the muni markets as well. So, is it the utilization, or is it the backstop that is being provided by these facilities that's really important? So, what does it all mean? I mean, the risks that are out there, sort of the bear case is, we're coming into a period where COVID is clearly accelerating again. We're probably in for a fairly dark winter on that front. You could have the economy stall as maybe we get some more targeted shutdowns, which could then cause that liquidity crunch, and you get spreads to blow out again. I don't know if you guys caught 2 weeks ago, there was a report that Bill Ackman has initiated his bet against corporate credits again. This was a position you might recall he put on earlier this year that made quite a bit of money for him. But so he's making a bet that we're going to have a credit situation coming into the market. And we've talked, I think, in the past with this group about the number of zombie companies that are out there today. And when we talk about a zombie company, we're talking about the operating income isn't even covering the debt service. Right now, there's about 1.4 trillion in debt within zombie companies in the U.S. market. Just to give you some sense, that's 2 times as large as we had in the financial crisis. And we've seen an increase of about 50% driven, by the pandemic. So, not a great backdrop to be pulling some of the, potential support away or the tools to deal with it away at this point. So that's sort of the risk that's out there. Then you could, again, I'll just call it the bull case. You saw the numbers from a utilization standpoint. There wasn't, these programs weren't really being utilized. We've seen earnings sort of recover. If you look at the earnings in the S&P 500, we're 94% above the lows. And I think we're only down about 5% year over year compared to a previous number of being down 21% was the expectation for the year. So we've healed quite a bit. Even at the state level, the state tax receipts look like they're coming in much better than anticipated. And then, the big one is we've got a vaccine, and the news on the vaccine front has actually been extraordinary. It's really blown away the expectations even within the medical/scientific community with efficacy rates above 90%. It's really a pretty good story, along with the fact that we're getting some ground made in the therapeutic area as well. So those are the two things that are out there. If we do hit again a patch of difficulty, we could be in for a market event that I would guess would be somewhat short-lived, because I do think at the end of the day, if need be, there will be more stimulus out there, and the Fed will be able to act with some of the tools that they have. They still have, I think, about $74 billion in the Exchange Stabilization Fund that they could tap on as well. But with that, I guess just open it up to comments, thoughts.
Sean, what's the source on that 1.4 trillion of zombie loans? You provide that?
Yeah, I took that out of a Barron's article. I don't recall who the author was, but that was in a Barron's article within the last couple weeks. And Mark, I believe, is it Yardeni that you're subscribing to today?
Right.
Ed's done a fair amount of work on the zombie companies. The interesting thing that I think Ed has also highlighted is there's an opportunity in there in that some of these companies will get to the other side, and they've actually been able to refinance their debt at much lower rates. So within that zombie group, there is some opportunity as well.
Any other questions, comments?
Hey, Sean, it's Rob here. On the zombie topic, do you have any sense of split between private versus public companies?
That number is all on the public side, Rob. So I don't know if there's what that number looked like if we included the private sector as well. When you say private, I assume you mean private lending, private debt.
Right.
This is the corporate side, the publicly traded corporate debt. Because what they're looking at are the financials, and they can see the interest payments versus the operating income. And what they're looking at is the business isn't generating enough to cover their interest costs today. Now, the question will be, as you go forward and we come out of the pandemic, for many of these companies, that dynamic changes. And to Ed Yardeni's point, some of these companies, that's going to be a powerful change because they've been able to refinance their debt at much lower rates here.
And then was the universe U.S. or was it a global figure?
The number I gave you is U.S., but there's a similar dynamic, obviously, playing out across the globe. But that 1.4 trillion is U.S.
Hey, Sean, Jerry Conley, how are you today?
Good, Jerry.
Great update. One of the other things, and I don't have the numbers behind it, there's been a lot of money that has been raised over the last 12 to 15 months in the distress market in anticipation of a lot of these companies hitting the wall, which has not happened. So there's been a lot of frustration on that. I don't know if you have any idea of, what sort of capital is waiting to jump into that market and when.
I don't, Jerry, as far as what the numbers are. But I do think, and just anecdotally, we work with a manager that does energy lending, right? And they actually, their opportunity hasn't been in the lending space over the past, call it 10 months. It's actually been in, the secondary market, the liquid market, because you had spreads blow out so much. They were able to basically trade that market very effectively now. And even within those credits, Jerry, the triple B spreads have come way in, but if you get out to single B, the spreads are still pretty wide. So there's probably some distressed opportunity there. And that's my guess, as you look across the spectrum of opportunities, there's pockets where they're deploying capital. And to your point, there's probably some frustration that you haven't seen a more broader opportunity in the distressed areas.
Thank you.
Other questions before we shift?
Hey, Sean, just real quick, I mean, just a kind of current event, slightly off topic, but what's your view on Biden's pick with Janet Yellen to kind of lead the Treasury?
Well, I think that's a very good pick. Short answer. I mean, you're going to have somebody that is, that little fraction that we have right now, given what's happened between the Treasury and the Fed, she'll be able to heal that pretty quickly. I was actually listening this morning to a Harvard economist, Jason Furman, and one of the things he highlighted with Yellen was she understands the power of low rates and what that can mean to help the economy. So I think from a fiscal standpoint, one of the issues the Fed has had is not getting that fiscal support to help the economy grow. And I think with Yellen, you probably have a pretty good selection as far as driving that that fiscal response, because she's well aware of let's call it the limitations of monetary policy and the power of the fiscal policy that stands behind it.
Okay, thanks.
Hey, Sean, that's a really interesting comment you just made about Janet Yellen and fiscal policy. And I'm trying to reconcile that with the common belief that, with Joe Biden's administration, taxes are going up for everybody, which sounds pretty counter to what you just said. And, have you thought that through to reconcile that, or where do you come out on that?
Well, does she become that balance within that discussion that raises that point that, you got to be careful about, the impact of higher taxes